Hello, good afternoon, everyone. My name is Kiana Danial. Thank you so much for joining us today. And just let's do a quick mic check. We have plenty of our attendees already on today. So could you please type in a Y for yes if you can hear me clearly? And type in a double Y for the double yes if you also can see the webinar. Thank you so much. And YY, thank you so much, everybody. So you can see and you can hear me. So that is a great start to today's webinar. We are going to give you strategies for major currency pairs. And because we have so much to do today, normally I would wait for more people to attend before we start. But today I'm going to just jump right in and show you and potentially even get a chance to answer your questions. So today's agenda, we're going to do an introduction. Probably I'll do that at the end of the webinar. We're going to do an economic overview on the US, Eurozone, UK, Canada, China, New Zealand, and Australia actually as well. And so the global market movers as of now, December. The major one has yet to come is the U.S. economy. We have a major announcement next week on December 16th. You guessed it right. Yes, it's the rate decision. Will the Fed hike the rates? We have commodity prices also influencing the markets. China's currency status is, we cannot actually, even though we can't trade the Chinese yuan on Orbex or any other forex platform. The Chinese currency status has been influencing the currency markets. We're going to cover that, how it is influencing the currency market. We're going to talk about euro, the eurozone, and the ECB surprises that has been moving the euro, shaking it up a little bit in the past week. We're also going to talk about New Zealand and Aussie economies. We have two major events coming up this week, today and tomorrow, in fact. And also we're going to talk a little bit about the Middle Eastern wars and how they are affecting the oil prices, which eventually affects the forex market. So without further ado, let's start with the U.S. economy. So I am assuming, first of all, let me ask a question. How many of you are absolute newbies, have never traded forex before? Because in that case, I would have to probably sit back and explain a little bit deeper. But okay, so that's great. It seems like we have a more new here. Oh, okay, Peter, hi. Hello. Okay, so we do have newbies here who have not traded before, I assume. So the U.S. economy, if you haven't heard what is going on, the U.S. economy has been doing great comparing to a lot of other economies, such as the Eurozone or, let's say, New Zealand and Australian economy. And in forex trading, you always have to trade each currency versus another currency. Therefore, no matter what you pick, you at least have to know about the economies of two currencies. Today we're going to cover the major currency pairs, and the major currency pairs are traded versus the US dollar. For that reason, the US economy is very important to us, and we have to know what is going on. So to give you just a very general view about the US economy, it is doing well, as I said before, but is it doing well enough for a rate decision for the Fed, for the Federal Reserve of the U.S. that foresees U.S. economy and their interest rates and inflation, and they basically manage what's going on in the U.S. and they try to balance out the U.S. economy. They have been hinting that they might start raising interest rates for the first time in so many years this December. And because of this, the US dollar has been on a very interesting, I'll say interesting because it is very interesting. It has been in an interesting move. For example, let's take a look at the US dollar versus, I have added so many indicators on this one, but let's say the US dollar versus the Swiss franc. As you can see, in the past, since October or even before that, the US dollar has been surging, has been going up and up and up against the US dollar, against the Swiss franc, I'm sorry. Against the Canadian dollar, also the US dollar has been going up. Again, for those of you who are new here, when we say US dollar, as you can see here, we have the dollar and then we have the CAD pair. Let me have my highlighter or spotlighter over here so you can see better. So we have the dollar and the CAD pair. When we are trading the US dollar versus the CAD, the US dollar in this pair comes first. What does that mean? That means the US dollar is the lead in this pair. I always use the metaphor of dancing currency pairs. So imagine that the US dollar is a woman and Canadian dollar is a guy and they're dancing tango. One of them is stronger than the other. So if the US dollar, if Miss USA is stronger, it would be leading Canadian dollar, Mr. Canada, forward, right? And that's why the currency that is quoted on the left side is the leader, and the stronger that currency is, the higher the currency pair moves, and vice versa. The weaker Canadian dollar gets, again, the higher the dollar CAD pair moves. On the other alternative scenario, for a bearish scenario, if the US dollar gets weaker and the Canadian dollar gets stronger, which direction would the pair move? It would move down. All right? Okay, so we just cleared that out for the newbies out there. And let's get back to the US economy and the effect it has been having across the board versus some of the weaker currency pairs such as the euro and Canadian dollar, Aussie dollar, and New Zealand dollar. The US dollar has been gaining a lot of strength. Again, here, as you can see, the New Zealand dollar is quoted first. That means the New Zealand dollar is the lead, and the stronger it gets, it moves, the pair moves up. The weaker it gets, the pair moves down, and the stronger the US dollar gets, the pair again moves down. So the combination, the perfect combination for forex trading is to pair a very weak currency versus a very strong currency. So for example, the dollar CAD pair is a perfect scenario at the moment because, as I'm going to cover in a bit, the US dollar is doing very well and Canadian dollar is not doing so well at all. We have the same scenario with euro dollar, even though we have been seeing some surprises in the past week that I am going to cover in a bit. So back to our economic overview. Taking a look, last week we had the non-farm employment change in the U.S., which is one of the major indicators of the U.S. economy, and it came out spectacular. It came out a lot better than expected, 211,000 versus the 201,000 forecast, and the employment change upgraded from 271,000 to 298,000. That is almost 300,000 non-farm employment added to the economy, and the unemployment rate, it's steady, has been steady in November. And that basically, because we have been hearing a lot from the Fed members such as Janet Yellen, and they've been saying they've been monitoring the economic data, and they've been waiting for the best signal and the best timing to raise the interest rates, and it seems like they are on track. The non-farm payrolls was one of the major outcomes, and we could actually be seeing a rate hike this coming Tuesday. A common question that I get is that, okay, the non-farm employment change came in really well, but how come the US dollar didn't change at all on Friday when the news came out? The answer is that, believe it or not, because this has been going on for such a long time, the speculation over the US Fed a rate rise, the dollar strength is already, the dollar has already priced as if they already hiked the rates. Isn't that interesting? That is the basically what they call it in trading, buying the rumor and selling the news. So the rumor has been that the U.S. is going to raise the interest rates, that the market already priced it in. So we are already at the highs, as if the market, as if the Fed already raised the rates. So what is going to happen next week? Last week wasn't very interesting. We had a much better than expected non-farm payroll. In an ordinary occasion, in an ordinary month, that would massively drive the U.S. dollar to the up move, to the upside, but it didn't. Therefore, looking at that and seeing that the U.S. dollar has been basically hovering, not really moving in the past week, we can be even more confident that the rate hike has already been priced in the U.S. dollar. So we have three scenarios for our next week interest rate hike. If the Fed decides to raise the interest rates, but just a little bit, what's going to happen then? In that case, if it's just a little bit, chances are the US dollar is not going to go up anymore for the remaining of 2016, because the markets, the participants have already anticipated that and have already priced it in. Although in the past 2 days, we've actually seen the US dollar going down versus some neutral currencies such as the Japanese yen. So in that sense, we can say that maybe that momentum, the bullish momentum, is fading off a little bit, and depending of the remaining of this week, if the US dollar goes further down before next week Fed rate decision, in case of a little bit of a tiny bit out of a rate hike, we could see the US dollar to move back up. But if the Fed does not raise the interest rate, in that case, we could see a massive dollar sell-off. That would mean that dollar pairs, US dollar, dollar yen, dollar Swissy, dollar CAD, would fall sharply on the news on an hourly basis. That does not mean that that is going to be there to stay. It is not a long-term projection. This is a short-term projection for the time that the announcement is going to get out. So write this down. These are the two scenarios. If the US dollar continues to move down before the announcement, which has been in the past 2 days, and the Fed raise the interest rates just a little bit, we can see a little bit of a pullback to where it was before last week. If it raises a lot more than expected, then that is when we can see a massive dollar buying, and the dollar would surge versus other currency pairs, again depending on how the other economies are doing as well. Right now we are only covering the US dollar. Just to keep that in mind, the US dollar is the main character in the major currency pairs, but you have to always look at the economy of the counterpart currency as well. Right now we're only talking about the US dollar, right? So the three scenarios, and the third scenario is if the Fed doesn't raise the rates in December, in which case we'll see a sell-off, right? We do have a bunch of questions over here. I don't understand the two different numbers, Peter. I don't understand your question. If you could be a little bit more elaborate. Kim is asking, is it the same as efficient market hypothesis, or is that John? Okay, Kim, John. Yes, you could say that. Yes, we have a lot of questions. So hold on one second. Tarek is asking, can you please explain It's very hard to read over here. I'm sorry. Can you please explain what happened last week after NFB with the U.S. gold event? I think I already answered your question. If you didn't understand that, I would definitely answer it again. The reason why it didn't go up was because the market had already priced it in. They had bought into the rumor. So that was a major reason why that happened, right? So moving on, that was that for the U.S. economy. I don't want to spend too much time on the U.S. economy because we have a lot to do. Next on tap is Canada, right? Canada is kind of in the opposite direction as the U.S., unfortunately. One of the main reasons why is that Canada mainly really heavily relies on oil prices, and as you may know, the oil prices has been going really low. On Monday it reached a 7-year low at 37, the WTI, which was crazy. It has been moving back up a little bit in the past day, but not as much as we wanted it. And not only that, the November employment change came in a disaster. It was minus 35,000 versus the minus 9,000 expected, and the unemployment rate rose from 7% to 7.1% instead of holding steady. And these are all bad signs for the Canadian economy. Last month we were actually talking about the Canadian economy falling into a recession. Now with the GDP coming out last week, as I covered on investdiva.com, the GDP showed that, okay, Canada may not be in recession anymore, but the outlook is not glorious as people would want it, right? And so for that reason, the Canadian economy on the fundamental side is not doing that well. Coming up for Canadian economy, the major one was basically last week, the employment change, and we have only one more month left, less than a month left for Canada to prove or to move a little bit before the New Year's. We have one more important event coming up next week on Tuesday, December 15th at 9:30 a.m. Eastern Time. In your time, that would be around 2:30 p.m. And that the outcome of that could potentially set the tone for the Canadian dollar for the remaining of the year and potentially for the coming year, which is 2016. Another thing that is coming up for Canada is their governor Polis will speak on Tuesday as well, and he will be giving some hints about Canadian economy that could help us understanding more. Before that, we will be having another webinar, so we may have some news up until then. But for now that we know a little bit both about the U.S. economy and Canadian economy, let's take a look at the technicals and see how and what we can expect from the dollar-CAD pair. All right, so I am a long-term trader. I'm not encouraging you to be a long-term trader, but normally this is how I start doing my technical analysis. I start zooming back to the monthly chart and seeing what has been going on in the past 10 years or even more. All right, so this is the monthly chart of dollar-CAD, and just looking at this is telling us a lot of stories, okay? First of all, we know that back in, let me have my spotlight over here, back in 2002, 2003, the dollar-CAD pair was all the way up in the, it's actually covered over here, was all the way up in the, hold on one second, I'm sorry, I cannot see the price over here. Yeah, in the 160 area. This is massive. So the U.S. economy was doing great and Canada was miserable. And then we saw a momentum change and the dollar CAD pair started falling. The crash happened in 2007-ish to 2008, and here the markets went crazy. The dollar CAD pair went up, and then it went back down again in 2011, and now it's moving back up. This pattern over here is called a double bottom. This is one bottom, and this is another bottom. And the double bottom chart pattern is a technical chart pattern that we use, and it indicates a reversal in the market, and it is confirmed once the market breaks above the neckline. Let me spotlight the neckline over here right now. So if we take a look at the object list, the neckline was at around 127. So that would be, I believe this is it. This is 131, but that is basically, well, that's about it. I would say it's 130-ish. That was a neckline, right? And just to highlight it, because now it's broken above that level, I'm calling this a pivot level at the moment. Okay, so this happened, the break above the neckline. We call it the neckline because it came up over here. This is a massive, major resistance level, and this is basically kind of the start of the double bottom pattern, and then it confirmed the break above it back in, when is this? This is in February. But then we had a few months of a panic. It hovered, it consolidated around here for a few months, and this month we definitely have the indication it has broken above. So from a long-term point of view, the monthly chart is indicating a very strong bullish indication. I'm going to back this up with another form of analysis. I'm going to shoot in a Fibonacci retracement, and as you can see, this brings us some more lines, some more levels over here. So this was our pivot level based on a double top pattern. We also had the 50% Fibonacci level over here, not that far away from our pivot point over here. So for that reason, this zone on a long-term point of view, if I can move this, it's pretty hard. Hold on one second. So we are going to the object list. We are going to make all these a little bit bigger so it's easier to move. Okay, so we are going to bring this one down to the 50% Fibonacci, right? So this was a long-term pivot point, and it successfully broke above it. Then we have the 60% Fibonacci level, which is a little bit more accurate of that what we had before. And guess what? The 60% Fibonacci falls very nicely at a consolidation level from back in 1995, 1996, and 1997. It's basically a middle ground. It has been zigzagging around this area. We never can set an exact price because more often than not, the markets averages it out. So it's best always to go somehow, some point in between the support and resistance for future trading activities. So we also had it's now testing above this level, which is a massive progress for the dollar CAD pair, and for that reason our next price point would be somewhere around here. I would say this would be the safest because, as you can see, back in 2004 the market had reached this level, it tested it, and then it went back down. So that was at the time a resistance level, and now could be acting as a resistance level one more time. And if it does break above this level, our next target, the extended target, would be the previous bottom, the previous support from back in 2000 that now is turned into a resistance. We've talked about the support and resistance a lot in our previous webinars. Also, we have the Orbex Traders Library that I conducted all the technical analysis ins and out that I highly recommend that you watch. Also on Invest Diva, we have more on this, so definitely take a look if you are not familiar with technical analysis. So we just took a look at a long-term outlook for the dollar CAD pair. Now we're going to zoom in to the daily, and I'm also going to add an Ichimoku cloud to help us with our technical analysis. Guess what? The market, this is the Ichimoku cloud right over here. What the Ichimoku cloud indicates is that if the market is inside the cloud, it's an indication of a consolidation or indecisiveness of the market. When it breaks above it, that normally indicates a shift of the market into bullish. And we have just seen that in the past month. So there you go. There is another bullish indication for the dollar CAD pair. So what's going to happen to the dollar CAD pair in the coming weeks, right? So Monday and Tuesday we had massively bullish, and today is consolidating. We have a spinning top right over here. Hold on one second. Okay, so no, that is not what I want. Okay, so we have a spinning top right over here right now forming. It tested our support level this morning and it went back up. And we do have some more, we actually, in the remaining of the week, what we do have is Canada's, not much, I'm actually looking at the economic calendar. The major event for this week for the dollar CAD pair is the U.S. unemployment claim. It comes out every Thursday. And if we have another better than expected unemployment rate, we could see more surges. But for the time being, because it has been a little bit of a quiet time today, we're seeing the consolidation. As a trading strategy, yesterday I told my students, the Invest Diva students, to wait for the market to go back down, touch this level, get into a bullish position, which they successfully did today. So what you do is you set a limit order and you basically ask Orbex to get you in whenever the market touches this level, and you go for a bullish target. I would target not so high at the moment because I would target 1.37-ish, maybe a little bit lower at the moment because we don't know the outcome of the U.S. Fed rate decision. If we see a start, we can obviously extend our target to higher. In a long-term overview, again, as I said before, the U.S. economy is doing great. If you are willing to stay in your trade for 6 or 7 months or so, then I would recommend that you get into a bullish position, targeting a very, not so moderate target such as 139 or even 140. But if you're more of an active day trader, I would recommend that you set your target a little bit lower and set your stop loss at one of these levels that I just identified. All right, so that was for dollar CAD trading strategy, mainly bullish, but is a wait and see situation at the moment. Yes, Joseph, that's correct. You can trade the dollar CAD for a long term. From this point of view. Again, these are all, let me just be clear on this one, these are all not hypothetical, but we are anticipating what's going to happen in the market, and what we want to do is to have as much data, as much information backing up our scenario. And normally we want to have not only the technicals backing up our scenario, but also the fundamentals, the market sentiment, and also our own gut feeling, right? Because if you're not happy with the decision, if you have any worries, any doubts that, okay, this might be exhausting, go with your gut feeling, because at the end of the day, not only we are in it to make money, we also want to feel happy about it. So you should never force yourself to do something if you don't feel right about it. At the moment, the dollar CAD pair is showing strong fundamental and technical bullish indications in the long run. As I said, again, this could happen anytime between 1 month to 6 or 7 months. And the currency market moves a lot. So for example, when was it? 4 months ago, I got into a bullish position right around here at 137. And right after that, guess what happened? The markets went all the way down to here. And I was panicking. But guess what? Patience is a very profitable virtue when it comes to forex trading. So I waited and waited and waited because I did have faith that the market is going to, this could be a temporary pullback and the market could go back on track. Right now we have 2 months of strong bullish candlesticks, and there is a very good chance that we can see a pullback over here, because after every up we normally see a pullback. The market gets exhausted. As I said, if you look at it as a dancing currency pair, if it's a dollar CAD pair dancing, they get exhausted. They want to shift the sentiment a little bit. The real reason behind it is because we have, even though the forex market is very large, $5 trillion worth of transaction per day, again, the actual market movers, the powerful banks and the governments who move the market, they have to keep the balance, so they cannot keep on being bullish all the time. We always see a pullback. So there is a very good chance that before the bullish scenario happens, we see a pullback towards 61, a level of Fibonacci level is 135, or even lower, and then we'll see the shoot back up. All right, so that is why getting into the market is as important as getting out, and you have to always be aware of that. Where would you put the stop loss? Great question. If you're in it for a long run, because you have to be more patient, this again, I cannot talk for everybody. That is why we have the private sessions at Invest Diva, because I really have to look at your account. I have to know how much margin you have, how much leverage you normally take. The leverage plays a big, massive role on your stop loss setting. Normally, these are the stop losses that I would recommend in general. The rest, you have to do the calculations yourself, or if you want me to do the calculation, you can take a private lesson on Invest Diva. So these are the levels. These are the high levels. The support levels that we have previously is the 131 and the 127. If you're day trading, or you're trading only this week, right, we have to look at it. What happened over here? We have to look at it. Oh, this is what happened. Okay. From a shorter term point of view, in which case we have to set smaller stop losses, right? So if you're getting into the market today, let's say getting into a bullish position, I would set my stop loss at this level. Again, though, you have to calculate your leverage, and you have to see how much margin you have left on your account, how many other open positions do you have. All right. Okay. So we talked about dollar CAD. I do want to go on and talk about at least another economy, or even more. The next is euro. It surprised everybody last week. So what happened is something very interesting, right? We were expecting, I think last time that we had the webinar, we were talking about the European Central Bank, Mario Draghi talking about, oh, we're going to do QE, we're going to stimulate the economy, the Eurozone forecast is really bad, blah, blah, blah. So people were expecting a massive rate cut and a massive stimulus and a massive quantitative easing coming from the Eurozone. And what happened is that they did extend the quantitative easing program. They did cut their deposit rates, but it was not as much as they were advertising. It kind of disappointed the market. So on ordinary occasions and in ordinary normally, when you have an interest rate cut, the euro, or the currency of that economy would go down. But what happened with a euro was that it surged massively in one day, over 300 pips, which is crazy. I got lucky because I was in a bearish position. I got in around here after we had the confirmation below 111. I got in to a bearish position. I had my limit order set at 1.0550, or actually it was 1.0530. I got very lucky and I got out of it before it surged up, but it was definitely a surprise, right? Especially for day traders or for people who immediately got into a bearish position after the announcement was out, because they were expecting the market to go further down. The reason why, again, as I said, was because of the disappointment that occurred among the forex traders, and a lot of people started profit taking from their short euro positions, and there was basically a lack of oomph in the additional stimulus measures, and there was a not so downbeat ECB growth outlook. And to further basically adding insult to injury, yesterday we had, was it yesterday, right, that we have the GDP results out of the Eurozone. And Euro had some other economic data as well. They came in not so bad. They came in better than expected. They were not as important, but they were basically a lot better than they expected. The German flash manufacturing on Monday came better than expected. The French manufacturing, it came unchanged. So it has been helping a little bit with the euro surge at the moment. But what is going on with the Eurozone economy in general? It's not doing so well. And when was that? So let's take a look at a history of the euro dollar. I'm not going to talk, we already covered the US dollar. And with the euro dollar pair, for a bearish scenario, what we are looking for is, what will back up our bearish scenario is US dollar strength and euro's weakness. That would push the euro dollar further down. Interestingly enough, US dollar is pretty strong. The US economy is pretty good, but because probably, again, people were disappointed, the market was priced in already, it is not strong enough right now to overcome the euro traders' surprise from last week. But technically speaking, again, I want to zoom out a little bit and take a look at the monthly chart of euro dollar, seeing what is going on in the euro dollar. What is the story of euro dollar at the moment? So it's very interesting because it's kind of similar to the dollar capper. Surprise? No, because, you know, they both share at least the US dollar in common, and they both share a bad economy in common. So back in 2001, the euro dollar pair was all the way down at 0.82. That was a really good time for Americans to travel to Eurozone, because it was great, right? It was very cheap. To buy €1, you only had to pay 0.82 dollars, which is even less than a dollar. And then over time, as the Eurozone gained strength, we saw the surge of the euro dollar all the way back up to here, right? And then it has been kind of consolidating, kind of a down point. This pattern, if you look at it, I'm sorry, I apologize for the Chimoku cloud over here if it's confusing you. Let me remove it for a second and we will bring it back up in a minute. So basically, a cycle started back in 2001. A cycle that reached the highs over here and is now basically going back down. As you can see, if you look at the higher highs over here, bam, 1, 2, 3, 4, it's going lower and lower, right? Interestingly enough, over here we had a period of a triple top pattern, like 1, 2, 3, and this was the neckline. We had the break below this neckline. We had the sharp drop after the triple top confirmation, and then it started consolidating. It started consolidating. This is 2014, and now we are here testing 105.50, which is a very, very, very strong support level. It has tested it back in 2002. It has tested it back in 1997. It has tested it multiple times in 2014 and 2015. But even more important than that level was the 108 and the 111 level, that it broke below it 2 months ago, which was a strong indication that we could see further bearish movements coming up, and that is the reason why I got into a bearish position 2 months ago, and I got out, fortunately, last Thursday, right? The reason why this 111 is very important is because if we zoom back to the daily, this is more of a recent important level that the market, and it's kind of in between this consolidation that we were seeing in the past since March, right? It's kind of a average point, and it tested it here and here. The more the market tests a level, the more important it becomes. So we had it tested here, we had it tested here, it was as a resistance, it tested it here as a support, it tested it here again as a support, and then it broke below it. So now at least we have the 111 as a very secure resistance level. Even though the euro dollar is surging, chances are it's not going to be able to break above this barrier. If it does, that would be a shift in the sentiment, and it's highly unlikely. Why? Because the US dollar, the US economy is doing really well, and the eurozone, I mean, they did add a QE program after all. And even though the market is very surprised by the minimal amount of the downgrade, but it's not, it basically still indicates that the market, the eurozone, is not doing well, and they need stimulus, and therefore we are bearish in this market. Again, so as I said, because the US dollar was already priced as if the Fed had raised the interest rates, it couldn't do much on the ECB rate decision. And now that it's going back up, this time we have a great chance that if we do see an interest rate hike next week, we could see a massive decline in the euro-dollar pair. As an alternative scenario, if they don't, then we have to wait another month, another 2 months until they do. And as a technical support, right now we're in between the pivot zone, between these two orange lines, the 111 and 108. This is our pivot line, right? If you want to get into a bearish position right now, you're going to set your stop limit a little bit above 111. Always have your stop losses a little bit loose, because chances are the market is going to test it and then move back down, so you don't want to get kicked out prematurely. So since 111 is our resistance level, I would set my stop loss at 111.85 or even 112. Again, this depends on your leverage and your margin. If you don't have enough margin, you have to set your stop loss a lot tighter. All right, this is for people who have a lot of capacity in terms of margin and are trading on a lower leverage. All right, you have to calculate that on your own, as I said. And as for a pivot line, well, right now for a short-term trade, 108 remains as the first bearish target. A break below it will bring us back to 105.50 as the next bearish target. And then again, on the very, very long term, if the pair is able to break above 1.05, actually not even 50, 1.05, that could open doors to further drops. And our next extended target would be around here, right? Because the market had tested it before, but if you want to get a little bit more precise with your stops and limits, we can always use Fibonacci. On a long run, it's not going to help us as much, so I'm not going to use it right now. Hold on one second. I'm actually going to remove it. So this FIBO we're going to delete. Yeah, we don't have much more choices besides this, but I did have the Ichimoku cloud that I also wanted to show you as a backup to show you why we are bearish. On the monthly chart, it is obviously below the Ichimoku cloud. Also on the daily chart, it broke below the Ichimoku cloud, and the Ichimoku cloud itself is moving down, and the Tenkan line is crossing below the Kijun line, which is also another bearish signal. So these are the reasons why we are bearish in the long run with euro dollar. And as for trading strategy, those are your limits and stop losses. We do have questions. I don't understand what's priced in the market. Okay, so there is a very common saying that people buy into the rumors. The rumor has been going on for the past 6 months that the Fed is going to raise interest rates. For every currency, when their country decides to raise their interest rates, that will make their currency stronger. So in the case of the US dollar, because the Fed has been hinting that they're going to raise the interest rates, that would mean that the US dollar is getting stronger. In the euro dollar pair, because the dollar is the quote currency, that would mean that the euro dollar would go lower, only if you're looking at it from the US dollar point of view. And the problem with that is that the market didn't wait for the interest rate decision to come out. It is coming out next week, but they already have been very, very bullish on the euro dollar, pushing the on the US dollar, pushing the euro dollar pair down and down and down, which it's probably already exhausted. It's already priced in as if the Fed raised the interest rates. I hope I was able to answer your question, Tarek. And we have another question. I understand that, but how do we fade by then? Yeah. So how do we know that it's already priced in? Okay, the reason why we know it's already priced in was because the US dollar, that is actually a great question, is because before it was going, the US dollar was going up with no concrete reason. It was just based on, like, you could see that every time that an analysis from a big bank or a big TV station or a hint from Janet Yellen come out, the dollar would go higher, right? So it meant that it didn't actually happen, but only the hints, only the talks about it was pushing the US dollar higher up. That's the reason why we know that it's already priced in. But again, as I said, because right now it's going back down, chances are that if the US dollar, if the rate hike does happen next week, we could see a move back up. And if it doesn't, then the dollar bulls are doomed. So do keep that in mind. If you are trying to trade anything versus the US dollar, try not to have more than 3 open positions versus the US dollar, because there is always a chance that the Fed is going to surprise us and not raise the interest rates, and in which case you would have to wait a lot longer for the Fed to decide to do it. It will do it at some point. We were thinking before that it's going to do it in 2016. Now it's 90% chance that they will do it next week. If they don't get really discouraged. If you do have the margin, you can remain in the position, but you have to be very, very patient. And if you have a very big position, chances are you have to really manage your psychology and not panic, right? But the recommendation is always don't have more than 3 positions open, because otherwise you will get killed, right? If the markets go against you. And the chances, like you could, you know what I mean, right? Okay, so next we have only 10 minutes, and I quickly want to review. Okay, we can only review either the Australian economy or the New Zealand economy. Let's see which one looks better. Let's take a look at, both are great. I would like to look at, we have the Australia's job reports coming today. So let's look at the Aussie dollar. All right. So the Aussie dollar. Let's go back to the. This is the hourly. We want the daily, not the hourly. On the hourly, it's been going down. The reason why is because iron ore went massively down, and the Australian economy depends massively on their natural exports and natural trades, right? Oil prices went down, commodity prices went down, and therefore the Australian dollar has been on a bearish point. And what we have right now coming up is their jobs report. Right, it's going to come out in a few hours, and let me just explain what it's about. It's the Australian Bureau of Statistics releases a monthly report on the current state of the Australian jobs market, which is of great importance to all forex traders and long-term investors and policymakers, because a better and a healthy labor market is a good indicator of a healthy growing economy. And also, the RBA governor, the Reserve Bank of Australia, Glenn Stevens, noted this December on his monetary policy statement that a stronger growth in employment and a steady rate of unemployment has been one of the factors why RBA officials decided to keep rates steady. So you see how different the Australians and the U.S. economy is. We are expecting Australia to cut interest rates, and we are expecting the U.S. dollar to raise interest rates. That's why it is a good idea to pair these two currencies up, because one of the currencies is weak and one of the currencies is strong. All right. So last time, if you're thinking of trading the news, trading the upcoming news, which is in about, I don't know, 10 hours, last time what happened was that the employment changed 58,000 versus 14,000 expected. And so that was great. The jobless rate went down to 5.9% versus 6.2%, and that is the reason why we saw the surge in the Australian dollar briefly, right? And at the time of the expectancy, yes, so the Aussie dollar went up, and then we saw it corrected itself afterwards. And what's expected this time is that the employment change is expected to go lower, actually, to minus 10K versus 58K last time, and the jobless rate is supposed to go up. So a better than expected report would obviously push the Aussie dollar higher up, while a worse than expected report will push the Aussie dollar lower down. And the US dollar, as we said, right now is kind of neutral in this sense. Technically speaking, let's get into the technicals. There was a double top pattern right over here. This is our pivot point. Hold on. I am a big fan of colors to make you understand these better. So we're going to mark this pivot point as orange. My pivot points are always orange. If you are subscribed on investdiva.com, you would know that. And what happened is that, well, as you can see, the Aussie has been going down and down and down, and right now has been kind of consolidating. It hit this 1.73-ish, right? Before it went back down, it hit it again. It couldn't break above it, which could be an indication that the market is in the verse of forming a double top pattern, which is a bearish reversal. So that would mean that if our scenario is correct, and if the jobs report comes worse than expected, we could see the market, we could see the Aussie going down to around this level, 0.70. But this remains still our pivot zone. As for our long-term scenario, as you can see, this market has also the cycle over here, and the cycles don't always go back to where they were before, but there is a good chance that if we do break below 0.70, right? You see how important 0.70 is, by the way? It was tested before back in 2006 and again around 2004, right? And then again around 1995. So it's a very, very important level, and a break below it could open doors for further declines, this time to our next level. I'm not going to go crazy about it. I'm just going to average out here and here. This is a previous resistance, a previous support, important level that the market has tested before. So 0.68 can be our extended target. Hold on one second. Okay, we normally mark our extended targets as purple. I'm just trying to do that right now for you. It doesn't let me. I'm not going to waste time on that. Okay, so here are our support and resistance levels for the Aussie. One more thing we could add to the Aussie dollar pair is certainly the Ichimoku cloud. So the Ichimoku cloud, well, on the monthly chart, as you can see, it's below the Ichimoku cloud. All the trend lines are down. It's consolidating this one a little bit. But on the daily, it's actually above it. It's testing above it. But the cloud itself is very, very thin. So for that reason, we don't have Ichimoku very much behind us. So we could see a pullback a little bit over here. And then here, the Ichimoku cloud is creating a zone of uncertainty. And a break below the Ichimoku cloud will all again raise our potential of being able to reach our target of 0.70. Myself got into a position this morning at 0.72 because we already had the confirmation, and I thought that it's going to move back up a little bit and then go back down. So I got into a bearish position over here. I am targeting 0.70, and I am setting my stop loss a little bit higher of our resistance level at 0.74 just to avoid a premature kick out of the market. All right, so those were at least 4 different currency pairs. I do have to do an introduction for you guys. So if you are new to Orbex's Traders Library, definitely do by the way, we have 3 minutes. If you have any questions, you have 3 minutes to ask me. In the meantime, while you're writing your questions, I'm gonna do an introduction. Do take a look at Orbex's Traders Library. There are massive amounts of information, and if you do want a one-on-one webinar with myself, go hop on investdiva.com, and we do have free market indications as well, which if you go to the must-reads, you will see the patterns and the methods that I use for my market comments. I use the dancing metaphor for our newbies, and we do also have a pre-recorded education video course that you can also enroll in. So it seems like we don't have many questions left, and I hope I answered all the questions that I saw before. Next time we're going to look at currency strategies for 2016. So definitely don't forget to join us for the next webinar. Thank you so much for joining, and I will see you next time.